It's that time of year, baby.
Let's freaking go.
Do you remember 21st night? Dude, I love that song. For those who don't know, every single day in September, Cade and I listen to that song. It is one of the greatest songs of all time.
For the past multiple years, we have done that.
It's why Cade decided to get married in September, and we tried to get it on the 21st, but just didn't work out. Had it been last year, had he acted sooner, he could have got married on the 21st night of September.
That's an L on my part. What was I doing? It should have been last year. Now,
Just
now,
slacking, dude.
now it's got to be the 27th. But at least it's still in September. We can blast the song, but definitely a missed opportunity. I should have moved quicker. L to your
Fumbled
boy.
bag. Fumbled bag. Let's get into it.
Let's do it, man. So it's kind of an interesting discussion. We're here, obviously, right at the beginning of September. We're looking to wrap up Q3, get into Q4, and finish out 2025. This year's been going by quicker than any year for me in recent memory. But I was combing through some of our previous episodes. We've typically almost every year since we've had the podcast, kind of towards the beginning of the year or towards the end of the year prior, we've had our good buddy of ours and mortgage lender, David Keller, come on, talk about what we're currently seeing in the market, but really give a prediction on what we're going to see. And what's leading this discussion, you and I have had conversations together about stuff that we're seeing in the market with Pinnacle, our own company. We've then talked to people independently outside of our company, and it seems that right now, and not just like the past couple days or the past week, but almost close to the past month, a lot of big players we've been talking to have seen a pretty drastic slowdown in their business. And whether that's a combination of less contracts being signed, less deals, less money being made, or all of the above. And so I think it'll be interesting to lead off why we think that is. But we know this industry has ebbs and flows. It's a wave. We can't ride a high forever. We can't ride a low forever. There's going to be times where we're busier, times where we're slower. And that's just the nature of the business. But it's kind of interesting to see it not only in our circle, but also branching outward, that the timing of this across a lot of big players in the industry, a lot of big companies are feeling this pressure right now.
Yeah, I think we've had just, do you get the question all the time? How's the real estate market? How's business?
Dude, all the time. I even had some retail clients of mine who have, kind of been window shopping for a while. We've been connected since earlier this year, beginning or end of last year. And they're like, what do you see prices coming down? Are they stabilizing? How's the market? What's going on? So yes, that is a
Yeah,
constant
I
question in the business.
boomers ask me it the most, and I try to explain some of the unique struggles our market is going through when they ask, and it's going to be hard to explain. And I think we'll have a couple talking points we can look at, some data points. Um, I've just told my blanket answer to that has been this year. This is a tricky market. It's been the trickiest market we've been in. Not tricky in the sense that we're losing money and the sky's falling. It's just been tricky. And it feels more than most years we've ever had. Like 1 week it'll be up, and the next week it's down, and the next week it's up. And it's funny because when you look at our listings, we experience it. We'll have a house sit on the market for 45 days and we'll get an offer over asking. And then it's strange. And so let's look and try to diagnose some of the stuff going on. And I'll let you lead the conversation, man.
Yeah. Yeah. And I think an important point to start before maybe we can pull up some helpful data is there's always a lot of chatter, especially when it catches wind in the media about interest rate cuts. Now, when we talk about the Fed, doing interest rate cuts, right? A lot of people think and assume that anytime the Fed comes out and says they are doing a rate cut, that is directly tied to mortgage rates being cut. And while mortgage rates typically follow kind of the either drop or the increase, depending on what the Fed decides to do, they are not directly correlated. Just because the Fed comes out and says they are cutting rates by however much of a percent or percentage points does not mean that your interest rates are going to be dropped or raised in the same exact percentage. Mortgage interest rates typically follow US Treasury bonds, right? Which is a combination of different factors: economic certainty, job reports, all of this stuff. But just to clear that up, I think that's also a lot of one of the main questions that I get is, oh, Fed came out and we're expecting 3 interest rate cuts between now and December. That's going to be great news for my mortgage. If they drop it by, you know, half a point or whatever, that means my, if I'm looking to buy a house, my rate's going to drop by half a point. No. So just to clear that up, I think it's helpful because that's one of the biggest misconceptions a lot of people have. Even newly green in real estate, that was, a conception or, you know, a belief that I had until I actually had somebody explain it to me. So while we may see these projected interest rate cuts by the Fed happen between now and the end of the year, if I were to make a hypothesis, do I think we are also going to get a break and a drop in mortgage rates? Yes, but it's not directly tied to the Fed and by whatever percentage points they're decreasing by.
So I'm gonna see if ChatGPT 5 can just build out a little chart for us real quick to see if it can kind of shed some light so we can see why people make this mistake. I was pulling up on my side screen to see if I could show the two charts, and they do look similar, but I think it would be better if I could have it on one. But what
Yeah,
you're saying is exactly right. Mortgage rates tend to follow similar to the Fed, but what the Fed does is not like exactly tied to how mortgages will work. Here's where I think there is a caveat to add. Enough people think like that I do think it actually makes a uh, strong effect on the market. Does that make sense? I
yeah,
think enough people hear the Fed dropping rates that buyer confidence goes up and more
absolutely.
transactions happen, but mortgage rates don't actually drop at the same time.
Yeah, yeah. And
While it's loading, I'm going to show something real quick on my screen.
let's do it.
One of the blessings of being virtual, and we've never used it, is sharing screen.
Yeah,
To my knowledge, have we ever shared screen?
no.
So I'm showing my screen. Can you see this? I just Googled Fed interest rate chart since 2020 to 2025.
Yep,
What you guys see here on this right-hand side is rates were pretty low and they started creeping up leading into COVID, and then they dropped. They dropped out super, super fast. They flatlined for a few years, and then because interest or because inflation was running rampant, you see that they just skyrocketed, and now you start seeing us tailing down a bit. I think it was Goldman Sachs came out and suggested that they're predicting um, three rate cuts, three consecutive rate cuts, which would mean we're going to continue to see this drop down lower. That
yep.
does not necessarily mean mortgage rates are going to follow along the same path. So you can see they lagged behind on the way down, but look at how quickly they skyrocketed up. A lot of mortgage companies started adding the buffer, the difference between what they're borrowing money and what they're lending money at. They increased that buffer because they knew rates were going to keep going up and there was so much uncertainty. And so they still have some of that padding and it may come down, but you've seen there's lots of variation within the mortgage rate outside of the Fed cut. I mean, you can see the Fed does not shake that much versus how rates are constantly up and down and up and down. It's because they're not perfectly tied together.
Yeah. And I think also, again, this is uh, a question that I feel like often gets asked, and it's typically on the retail side, people who are not as in tune or educated in the real estate or home buying and selling spaces. When can I expect to get a killer interest rate? And when I ask what a killer interest rate means, they say, well, like what they have it in, what we had in COVID. I want a 2% mortgage. I want a 3% mortgage. And as unfortunate as it is, you and I make the joke all the time. I mean, we wish we could have bought real estate back during the crash of 2008. But when we talk about these crashes and getting back to, what rates were during COVID, I don't anticipate. Again, and you never say never. God forbid another type COVID type event that drives any of that stuff. But anybody who is a young professional looking to purchase their first home, anybody who's looking to sell their current home and move to a forever home or whatever it is, we are not going to see those anytime soon. And I can say that very, very confidently, and not just anytime soon, for the vast foreseeable future. So I think um, I think as we play out the end of this quarter and looking towards the end of the year and the beginning of 2026, I do hope that this kind of struggle period we've had for about the past 4 weeks, um, as we lead into the new year, we start goal setting at the end of this year, what next year is really going to look like. I think you're exactly right that I hope and anticipate that buyer sentiment with these cuts is maybe going to give that injection, that little boost to the market and to the business that we haven't felt for the past month or so.
Yeah, I mean, we're talking out of our pay grade here, but you know, when we made our prediction earlier this year, we were expecting the market to come back stronger this year. It's just not been the case.
No.
The same way that Jerome Powell and the Fed were slow to react to inflation, they are slow to react to the correction now, right? Real estate, the economy as a whole is cyclical, and it feels like we're experiencing more of the same, where we were saying rates should be coming up or should be going up, should be going up, should be going up. Now it's rates should be coming down, should be coming down, should be coming down. And it seems as if a lot of the indicators are positive that they're going to be lowering rates, but it also feels like we should have been lowering rates throughout the year, not just at the tail end here. I want to look though, because the Fed really affects a lot of stuff outside of real estate. If we're going to talk within our pay grade, I think the place to talk would be within our own market and the knowledge that we have. I also want to call out that 4 weeks down is not necessarily a trend. It's just a data point. Like we talked about on the last podcast, being careful about jumping too hastily. So I think it'd be interesting. I can help drive here if you want me to, looking at the trends over a longer period of time and seeing what we can see from there. Does that work?
Yeah, let's pull them up.
So we're going to use our realtor database here to give the Fresno market, which is the Fresno MLS area. This would be just the Central Valley, and not Bakersfield, not Merced, not Modesto. This is really just Fresno, Clovis, and the surrounding cities around it, to see. And the first chart that we're going to look at here is the question that seems to be everybody's thought is, what's going on? This is going to tell us what's for sale, what's sold, what's pending. Just raw numbers. Units of measurement are just houses, not pricing, not volume, nothing else. So what are you seeing, Cade?
We go back as far as June 24. The first thing I want to look at when I see a chart like this is I want to look at not only what have the recent months shown, because if we look back even, in Q3, we look at the past, or if we take the past 3 months, we can see the solds are down a smidge. That July of 2025, we're right at that 800 mark, and we're maybe a hair below that in the 700 to 750 range in August. So number of homes that actually sold dropped in August compared to the previous few months. But what I think is really interesting to look at is, what if we take the most previous month's data, which is August, we're between 700 and 750 homes. What did August look like last year? And if we go to 824, we're a little bit above that 800 mark, if I can see this correctly, are sitting right about,
You can
oh
see
yeah,
right
you've got it
below.
down there, 790. So the actual number of homes sold is down, but the
Yep.
actual number of homes that have been listed is about 400 more. So that discrepancy is bigger significantly than what we saw in August of last year compared to how many homes were up for sale versus how many homes actually sold.
Yeah. Something that stands out to me is more houses went pending in that time frame. Something to talk about in the real estate market. Typically, it's slower in the early months. It picks up in the spring through the summer. And then when school comes back, it starts to taper off. And you can see that right here, right? So in the summer, it's ramping, ramping, ramping. Excuse me, in solds, ramping. Then you can see school hits and there's this drop, right? Even last year from July to August. And then it stays pretty even. It dips in the winter and then it starts ramping back up in the spring. And then this year, what's been strange is our best month was April.
Hmm.
And then you can see it still has a little bit of a curve. If you take out April, it's the same curve, right? So it's just
Very
people need to be
identical.
aware when you're buying, flips, and selling real estate, understanding the time of the year you're going into, right? So if you're living 6 months in the future with a flip, any deal I buy right now in August, we're going to be selling it kind of in this time frame where there's typically less sales. There's more houses for sale, right?
And that's an interesting point too. And we can be open and honest about just kind of the state that our business is at, because you're exactly right. Anything that we are purchasing right now and we decide to fix and flip it, it is not going to most likely sell in this year. We're going to be listing this property in a typically slower time at the very beginning of the year, winter months. We're wrapping up most of the big holidays. But what's been interesting is over the past few weeks, we've been very diligent about having more of a wholesale pipeline and having our business. I mean, this year has been uh, the biggest year in the sense that we've shifted to try and lean a little bit more wholesale heavy as opposed to fix and flip heavy. But right now, all of the things we're looking at, all of the things that we are trying to make pencil are all leaning majority fix and flip, which leaves us in a tad bit of a frustrating position because we have our goals that we set not only for the year but into Q4 that okay, if we can only sign things right now and make things pencil as a fix and flip, where's the rest of that money going to come from for us to hit our goals? Because that is not going to come from the flips we're signing now. It's great if we can sign some good deals and start off 2026 ideally in a solid position, even in a typically seasonally slower market than the summertime. But that leaves us in a little bit of a frustrating position. And I think from the conversations we've had, some of the other people that may be listening to this podcast and are in a similar position with their business, I think we just need to come to terms with that reality. You don't want to pass on a deal just because it doesn't match that you want to lean and bump up your wholesale pipeline or your wholesale volume. We need to be capitalizing on deals any way we can. And if it happens to be the only way we can make a deal pencil is with a fix and flip, then so be it. But we need to set those expectations and come to terms with reality that right now, yes, all the contracts we're signing may not be realized until 2026, but we can't lift our foot off the gas pedal just because it's not matching identically to what we need now and the cash that we need to see through the end of the year.
Yeah. I mean, I pulled this back to a few years so you can see the trend more clearly. But I mean, if you just look at solds, it does the same thing every year. It's a wave. And you can see since the interest rate cut started, we dipped in houses for sale, and now the market's coming back. More people are
Mm-hmm.
willing to move, right? Those step up buyers are kind of coming to reality. But you can see this exact same pattern. It keeps happening, right? And you should expect it when you're experiencing a slower season, right? And when you see less people selling, you know, it should it should just be expected. Something I wanted to look at is average price per foot. In fact, this is for the trolls. This is
Hmm.
the last 5 years, okay? This goes back to 2020. And you can see back in 2020, this was mayhem time. And then this is when rates went up, like climbed crazy, right? In fact, did I close that screen? Okay, so rates started going up right at the beginning of 2020. And by 2023, they're at their peak, right? Look what happened to the inventory. It skyrockets, right? I want to look at price per foot. Remember, everybody said, I'm going to wait for all the prices to crash?
Yep.
Hmm.
Look at
Hmm.
that.
Crazy. Prices didn't crash. So what do we expect happens if real wages aren't going up, less people can afford to buy, prices aren't dipping because there's still enough demand, right? Basic supply and demand curve. If demand goes down, prices have to go down, right? If supply goes up and demand doesn't go up, prices have to come down. We're still kind of in the same spot. But if you look at months of inventory, you have more options. And so that's where we're experiencing delays, right? So months of inventory is how quickly, if no more houses hit the market, how quickly would all the houses be bought? During COVID times, it dropped as low as zero point 0.9 of a month, meaning if no new listings went up within that month, there would be no houses on the market. We're now sitting at 3.4 months, which is
Yeah.
still considered pretty good. It's just different. Um, and then the days on market is the last thing. You can see in the wintertime, houses sit longer. In the summertime, houses sell quicker. Wintertime, they sit longer. Summertime, they sell quicker. And so we're experiencing part of the natural curve, I think. And I think people need to not lose their, mind and feel like the sky is falling, and you need to still make good business decisions, and you need to be aware of this going into the winter time. That, hey, school's back up, people are busy, less transactions are likely to happen.
Now, here's a question I'm curious because you also have, we've got our business coach for the company. You also have a business coach on the sales side. When we're sitting here and they ask, we set goals with our business coach, not only for a yearly target, but we break it down by quarter. We have a Q4 target goal. We had a Q3 target goal that we'll be meeting with our coach in about a month. We're not ones to sit here and make excuses. So what does the conversation or the answer even look like? And even if you don't have a business coach, but you're a business owner, you answer to your business and you may have a small team. What, how do you even explain or combat that this is just the state of the market and it's an easy cop out answer to say? But when we set those targets, you and I have even had this conversation together with our coach. When you set those targets, they're not meant to be set to be changed. When you set them, you set them. And ideally, when you're setting those goals, you're taking into account the ebbs and the flows, traditional seasonally of the market and stuff like that. But what's our answer? Because at the end of the day, you and I are accountable for these key KPIs in the business. What's our answer other than just taking the easy way out and just saying that this is how it is right now?
Well, we're right now on the sales front. We're about 2 weeks behind schedule, meaning we have 2 weeks of non-performance, which is what literally happened. In this quarter, we had 2 weeks where we missed our target,
Yeah.
and it reflects in our numbers. We didn't have 2 weeks that overdid it and crushed. Ultimately, the answer that I would say is you're paying me not to lose money right now because there are plenty of people that are buying up deals that don't make financial sense, or they make financial sense for them, but they do not make financial sense for us. And the best thing that you can do in this market is really, I'm trying to think of the term, is it batten down the latches? Is that the saying?
Yeah,
Regardless,
yeah,
it's tightening up every part of the operation to make sure that you are making good on what you have. But frankly, not every year in real estate can be a blow up year. And you need to start looking at what pivots can be made, right? A big issue we're experiencing right now, and it could be a trend, is we're seeing so many people that need to sell that don't have equity. It looks a lot like 2008, frankly. The big difference is they have really cheap mortgages. A
yeah,
lot of them have pretty cheap mortgages, but they have no equity, right? Because they refi towards the end. Or there are some people, there's not as many, but there are some people that have these high interest rate mortgages. They have no equity, and then something happens, and now they can't afford their house. Yeah, I mean, foreclosures are going to have to go up, or short sales, right? And we've been through short sales, and those take forever. And very often, the bank is not willing to let go of the property for a price that an investor in this climate can pay. So
hmm
you're asking, where are we at? The answer is, let's look at the data that we have in our system, right? How many opportunities do we have come through? How many of them were feasible to go on an appointment? How many were offers made? For the ones that we didn't make offers on, why? Like that's really where you have to go to, is just like, you got to keep your head on straight and not sign a bunch of stuff just to hit a stupid goal. Ultimately, the goal is to make money, and if those deals don't make money, there's no point in signing them.
yeah. I think also too, you made a good point earlier that now is not the time to act like the sky is falling just because, we're in this state of a funky market. And like you said, the majority of this year has just kind of felt funky. Now, when is the time, and you made this point, to, button down the hatches, make sure that your team, your processes, your people, everything is so dialed in, and there's really no perfect time to make those changes. But if I'm sitting there as a business owner and saying, okay, I know I need to tighten the ship, am I going to look to try and tighten the ship when we're hit with a good market? Like if we're looking optimistic into 2026 and we're hoping that it's not going to be kind of this funky market we've experienced this year. Because also, if you look at it on a year to year basis, again, real estate goes in stages, ebbs and flows, right? And so I think you made the great point of saying that now, when times are a little bit harder, is the time to double down and make those changes and make those tweaks to your systems, your people, your processes, so that when the time does come, and we know it's going to, when the uptick does come, your team, your business is in the best absolute position to capitalize on a good market. And you don't want to be trying to make those changes when the good market's already here, because then you're fumbling and your competitors are already made those changes, have already tightened up the ship, and they're a well-oiled machine, cranking, wheeling, and signing every deal out there while you're sitting there twiddling your thumbs, trying to figure out what changes you can make. So I think that's a great message for business owners and people who may be feeling that existential pressure right now, feeling kind of uncertain and maybe a little bit defeated on how funky this quarter or this year has been for them in their business. Now is the absolute time, because if you can make it through a type of market that this year has been, and tighten up and become an absolute killer of a business, the fruits of that labor are going to come when we get a good year and a good market.
Yeah, in my experience, most of the time we buy our best deals in the winter and we sell them in the spring,
Yeah.
or we buy them in the early spring and we sell them in the summer. And I think right now is the time, if you are slow on opportunities, to be doing the daily tasks, the planting of the seeds, watering, making sure you're staying in touch, continuing to look at your systems and improve and make sure that there's nothing broken, so that when the natural ebb and flow comes back, you're even more prepared than last time, right? I'm gonna share this. I increased it to 10 years just to hammer this point even more. Can you see my screen?
Yep.
This happens every year. This is the pendings, the buyers buying or putting houses into contract. And you're at that point right now where we should expect it to come down. We should expect inventory to go up. We should expect sales to come back down. And that's just the natural ebb and flow. And you can see this is where we were from 2015 all the way to 2020. This was what we all remember and what we all recently feel like is a good market. This was a good market too. Like, this is going to be normal. Now
Yeah.
it's figuring out what's going to happen, because honestly, you can see price per foot has climbed, dipped a little. We're back above COVID pricing at this point.
Yep.
You see that?
Even with, you know, triple the rate, or, 2.5x the rates of what we had in COVID. Average prices are higher.
You can see this was a good market. Days on market were normal. COVID hits, days on market drop. Everybody remembers this. We're right back to where we were. The only difference is you can see how much more jagged it is.
Yeah.
This is what I'm saying about, like, the last few years have been kind of tricky. Things move more up and more down. This is days on market. How long the house sits? 58 days on market was normal.
And when was
Price and
that?
sales.
2019? Yeah,
This is
shortly.
2019.
Yeah, shortly after you got in the business, right when I was starting, pretty much.
This was the last 10 years of inventory. Everybody remembers this and reminisces on this, but this is pretty normal. This is not normal.
Yeah.
This is what we're experiencing. And this comes from uncertainty, right? So when we're talking about if 2026 is going to be a good market, it really has more to do with a bit of like a leveling out in the highs and the lows. Not that the market's going to come way back down to COVID era. That was not normal, and it shouldn't be that way.
Yeah, just aiming to get back to some sort of kind of flow state where there are not as much swings in the pendulum one way or the other, exactly like in that chart you were saying, outside of COVID, as recently where we had that big drop and then another little drop. There's not a lot of consistency there, and it comes from, exactly like you said, the uncertainty. I think another thing to keep in mind to tie this into it is, I think a dangerous school of thought is, if you're a business owner, to be sitting here and saying, all right, I hear Scott and Cade saying it's a funky market. It's been a really hard, funky market for me. I hear other people saying it's been a hard and funky market. So, I think these struggles I'm having in my business, everybody else is having them. So I think it's just a function of the market. The reason I think that's a dangerous school of thought is, again, it ties back to what you were saying. And we just did a whole podcast episode a couple weeks ago on key KPIs and metrics to track every day, every week, every month, every quarter, every year in your business. Do not just latch onto the school of thought that your business is struggling because it's a funky market for everybody. You really need to do an internal audit of your business, your people, your systems, and your KPIs. Because again, our team champions ourselves on controlling the controllables and being at peace with the things that are uncontrollable. So if we know we are hitting our KPIs in terms of number of calls, we're sending our mail consistently, we have our speed to lead dialed in, the time it takes for us to call a lead back if we can't answer that call right away. If you have that resume that shows, okay, everything that we can control is as dialed in as it can be, then we know, okay, the thing we can't control, which is the market, is fine. We're at peace knowing that we are absolutely dialed in with the people, processes, and systems in our business, and we're going to weather it out. And we're going to continue to do business in a funky market. But if you don't have that resume to look on, if you don't have those KPIs to look on, if you're oblivious enough to just attach the struggles on your business to what other people are experiencing, again, you could be absolutely shooting yourself in the foot that when the good times or the better times or the stronger market comes around, everyone else is going to be telling you, yeah, dude, we're freaking crushing it right now. And you're going to be sitting there twiddling your thumbs going, well, these guys were just struggling when I was, and I'm still struggling. Why are they absolutely killing it? It's because you didn't have an audit of your controllables, your time, or your people, your processes, and your systems. And now's the time to do that audit, especially heading into the end of the year. What do you need to do to make your engine more oiled? What can you do to make it a stronger functioning machine to not only power through these funky markets, but capitalize on the good markets? And those are tough conversations. We've been having those tough conversations over the past few weeks. We're actually looking to you've been spearheading making a new hire to bring on an additional person to the team. And when we when you say, and when we're saying right now, to really take a fine comb through your business and to tighten the ship, tightening the ship can also mean bringing on more people. It doesn't necessarily need to mean making cuts, but it can. And you need to include both of those things in there. And we saw a dire need in our business to bring in somebody in the South Valley to make us in a better position for when we hit that stronger market. And now we're going to be a much more well-oiled machine when the stronger market hits.
Yeah, I agree with everything you said. I think at the end of the day, this is a great opportunity to step up to the occasion. If you can cut your teeth here, you'll make it. If you decide to stress ball out, which you and I have both done at times, and just get freaked out by the results and trying to control things that are completely outside of our control, you're not going to make it. And so here would be like the message I would leave listeners to right now. We should be expecting an activity slowdown for a bit here with school starting. We should expect a little tick back up before Thanksgiving. Then we should experience a slowdown through the holidays, and we should know it's coming and use the time where we're not going to be on every single appointment all day, every day, to really learn where are the gaps in the business, where are the gaps in our skill sets, where are the gaps in the processes, where are the gaps in the marketing, make the adjustments so that when we expect the market to come back, like it has every single year in Q2, that you are prepared to capitalize and make hay while the sun is shining. So that would be the focus. And that's what we're doing. We're onboarding, we are training, we are reevaluating actively what needs to change. We're already looking at 2026 right now, knowing we have time right now to fix stuff. And if we wait until we have the opportunities, it's already too late.
And I think to tie back to something we mentioned at the beginning of the podcast, do not get trigger happy just because times are funky or times are tougher. Signing no deals, I would argue, is better than signing bad deals that are going to lose money.
What leaves you with more money in your account? Signing no deals for 2 months or signing one bad deal in those 2 months? It's the one that costs you $0.
Yeah.
I'll tell you that. So if you are working the process correctly, you are running your numbers, be conservative. That is okay to have some slow times. as long as you can prove that you did all the tasks, all the responsibilities to follow the process.
100%. What we'll need to do is we're wrapping up here. We've had one virtual guest on the podcast so far. Your coach Jenny, she absolutely killed it. I think over these next couple weeks, as we head into Q4, we'll need to bring David Keller back on. We can kind of do a temperature check and compare what our analysis was at the beginning of this year and get a temperature check from him. He is in the weeds every day on the mortgage lending side of the business. Definitely has a lot more knowledge in that space than you or I do, to really see what we may expect going into 2026. And so I think for everybody out there who may be feeling this funkiness, might be struggling a little bit, keep your head down, control the controllables, let the market be what the market will be, because that's always going to be the case, and get ready to capitalize when the strong market comes.
And we'd be remiss if we didn't say this. This is a self-plug here. We just rebranded our company to Pinnacle Home Buyers since our last podcast.
Yeah.
Go follow us on Instagram at Pinnacle Home Buyers. We are posting constantly on there. Give yourself the opportunity to see what deals are being made, the behind the scenes, what we're doing. Shoot us a follow, and we'd greatly appreciate it.
There it is. We'll see you guys next week.
See you guys.